Let me also thank the organizers for including our paper in this really great conference from which I learned a lot. And I'm fully aware of my responsibility of presenting last, that I'm standing between us and the fun activities. So I will do my best. And maybe the benefit that I have going, having seen all the work, is that maybe I'll be able to connect the dots with some of the papers and reconcile some of the findings. So this is a paper with Pierre-Olivier Grandchat and Oleg Yitzhoki, and Pierre-Olivier and I are at the IMF, so the usual disclaimer applies. We, of course, as all of you probably, with this paper, wanted to understand what are the drivers of exchange rate. And we are macroeconomists, and we start from the observation that exchange rates seem to be very disconnected from aggregate macro quantities. And in contrast, we see exchange rates are very strongly correlated with wedges such as the UIP deviations, CIP deviations, which are wedges that intermediate currency supply and demand in the currency market. So we must look at the currency market, and basically we follow this in the spirit of Evans and Lyons' paper and other recent papers on segmented market, try to identify supply and demand quantities in the currency market and see if they are more correlated with exchange rates and why. So we have two goals. One goal is an empirical goal. We want to characterize joint panel data properties of exchange rates, both spot and forward, interest rates, and currency premia. So Hao-Nan and Lorena presented you, important characteristics of CIP and also UIP in emerging markets. We want to present a framework that is general enough that would apply to a broad cross-section of currencies, G7 or EMs. And we also want, the second goal is to think of a model framework which is minimal enough to be able to explain the panel statistical properties that we see. And this will be a very simple partial equilibrium model with frictional intermediation, which will offer a shell for our empirical analysis. So what do we find? Our outcome variables are the exchange rate, both current and future exchange rate, the forward rate and interest rates, which form the currency premia, the predictable UIP and CIP deviation. And two additional variables will help us organize the data and connect it with the model. So in the cross-section, we will show that a measure which measures the relative scarcity of local currency funding, which we call A, will explain very well the cross-sectional distribution of interest rates, CIP and UIP deviations. In contrast, in the time series, we will have a variable which is the futures position of dealer banks in the CME, which will show very strong correlation with this premia and the exchange rate. So just a few words, this funding gap explains in the cross-section, and we'll leverage a very comprehensive data set that at the IMF we have about external gross asset and liability position in different currencies. And what you'll see is basically currencies with excess saving, think of the yen, for example, will feature low interest rates. That's where we have a lot of savings. And they will have negative currency premia and cheap forward dollars, and vice versa in currencies with a positive excess local currency saving. And in the time series, this currency futures position will statistically explain a lot of variation in exchange rate and UIP. And here's where the behavior of the two wedges will differ, because CIP or forward premia will behave very differently in the time series. And the reason why the dealer's futures position will correlate so strongly is because it reflects demand for currency risk, which needs to be absorbed by the intermediary, and the intermediary will absorb this by charging the UIP premia, and that will be associated with exchange rate changes. I will not have time to go into this case study that we have in the end, but what happened to the dollar since post-Liberation Day in April is very well in line with our mechanism we proposed, because the dollar depreciated very sharply without us seeing very large capital flows out of dollar assets. And what happened is that we hear a lot anecdotes of foreign investors hedging their dollar position. And if you look in exactly this futures position, you will see a large increase in a large increase in negative dealers' position for the yen, for example, which hold a lot of treasuries. And so it's the currency risk that is shattered by foreign investors and leads to the exchange rate dollar depreciation, not necessarily flows of spot capital flows. Let me just present the contours of the model because I need to get through a lot. This is the model of an intermediary. It can be bank, can be non-bank. Let's think of it being the bank. It borrows in dollar. It can also borrow in foreign currency, but it's the same, borrows in dollar. And on the asset side, holds reserves, invests in dollar investment, which are risky, and can invest in foreign currency. A is the net spot on balance sheet currency exposure. And also off balance sheet, it can hold futures and forwards, which is F. F is aggregated both futures and forward position, as well as currency swaps. And the return to this off-balance sheet position are these expressions over here, where, of course, the forward will have a currency risk in it, whereas the return to the swap is riskless. And just to summarize the evolution of net worth, the evolution of the intermediary's net worth will depend on the different positions that I just showed, and you can organize the position into in the last two terms, the X position and the Z position, where the X is the sum of the forward futures and the swaps. They will earn the CIP deviation. And the Z position is the currency risk position that the intermediary needs to absorb, and that will earn the UIP deviation. So these two positions will be key going forward. These are the different trades that intermediary can do. With the $1 in T, it can do these different trades. The first one is the UIP trade using the spot. The second one is the trade using the forward, and last one using the spot, to earn these different returns in T+1. And there are these three trades, but they are linearly dependent. So you can summarize the return to the net worth of the intermediary using only these two positions, X and Z, that I showed before, right? And so what determines this position? We need some constraint. And the way we model the constraint in this paper is that we impose that the intermediary holds some sort of liquidity coverage ratio on the different position, and this requirement is different. For the risky dollar position H and for the risky currency exposure Z, it needs to hold reserves, or B basically is the reserve, which increase, the marginal cost of reserve increased with the size of the position. So it's a convex constraint, whereas X is a riskless position, right? The CIP trade is riskless. There's no exchange rate risk in it. There's only counterparty risk. So for that one, it's a proportional liquidity requirement delta. And these are assumptions, but they will naturally arise in a framework of value at risk. And why? Because the volatility of the intermediary's net worth is proportional to the H and Z position. And so the constraint that you will derive from that value at risk framework would be in this shape. So what do we get as the solution to this? We'll get that the UIP deviation, and the bars here basically is an expectation, will be increasing in the currency risk exposure Z, and it will be increasing more if the shadow cost of expanding the balance sheet mu is basically the, if a dollar borrowing has a higher rate than the yield on the reserves, then this constraint is binding. And so the higher that shadow cost, the more will UIP have to increase when an increase in the currency risk exposure. Whereas the CIP, it will also be related to X, but it will only inherit the sign of X. It will not increase linearly, and that is because of the constraint. The counterparty constraint makes the CIP, the reserve requirement CIP, be linear and not convex. And so the CIP will be kind of a step function in X, and I'll show it in a minute. The important thing to take away here is that the F, the forward and futures position, is both in the maybe it's not clear here, but it's both in Z and in X. I think it was here before. Anyway, it's both in Z and X, and so it earns both the UIP and the CIP premium. When you aggregate, this is the math for the aggregation. Basically, you will get that in equilibrium. UIP and CIP premia are a function of the aggregate demand for currency risk Z of the market and the aggregate demand for the hedged currency position X. And the delta here, the delta T, when you aggregate, will be the intensity of the constraint of the marginal intermediary that has to step in. Of course, here I was talking about supply and demand, but when we go to the data later, how can we know which agent is supplying, which agent is demanding currency? We don't. So let me show you how we think about the identification when it comes to the data. So the market for currency risk is a zero net supply market. So positions have to net out to zero. And we think of each agent actually having both a slope and a shift in their demand for currency risk. So the slope, rho, describes a change in your currency risk position that co-varies with the expected return, UIP. But then at any point in time, you may also want to shed or increase FX risk exposure for other reasons. That's the lambda, for hedging, for portfolio rebalancing, for speculating, whatever. The important thing is that it's a shifter in your demand for currency risk. And since the UIP is the same across all agents, you can solve it to be basically a weighted average of the shifters for all agents. And then furthermore, when you write it out in first order approximation, the change in the currency risk demand Z at any point in time for any agent will have a slope with respect to the UIP with the stable slope, and then this new shifter psi, I think, will be a collection of the true shifter lambda, variation in the slope, because the slope for a given agent can also vary over time, as well as variation in its wealth. That's W. So putting everything together, we will have that the UIP and the UIP deviation will be a weighted average of aggregated over the demand shifters of the whole market. And if we look at a certain set of agents, call them I, and this agent's I's position will be a linear function of the demand shocks to the whole market, net of its own demand. And so if we can find an agent I and a proxy for its currency risk exposure, and then project the UIP on this exposure, if we get a high R square and a positive slope, it will mean that this agent has a positive slope, a stable slope, and relatively little demand shocks. And that would be what we call the currency supplier, because it has both demand and supply, but overall, the supply curve is stable. So here's to illustrate it, right? The intermediary supplies Z, supplies the currency risk that is demanded by the market. The market demand is given by the red line. It can demand both either spot or forward futures exposure, and the Z will be the resulting currency risk position. And in the CIP is very different. The CIP, you remember, with variation in X, it is flat. So it's a flat step function. The step will increase when new intermediaries need to enter the market. That will happen if the demand shock will be very large. And then when the mu, which is our marginal cost of balance sheet expansion, when that increases, you will see like a widening of the step function. And that will also happen to the UIP curve. It will also rotate and increase for any level of demand. So to summarize the prediction, and I'm going to the data immediately now, in the cross-section, what we expect is that for a currency where there's an excess supply of local currency saving, as I said, the yen, the Swiss franc, you will expect a negative UIP. You will expect the interest rate to be lower than the dollar interest rate. A negative CIP. Why a negative CIP? Because there will be demand for negative F. There will be demand to sell dollar forward and buy the local currency. That's the hedging channel that we have talked about before. And so the dollar futures will be relatively cheap, and vice versa in emerging markets or investment currencies where there's a lack of local currency saving. And they will expect to have a positive UIP, positive CIP, and expensive dollar forwards. So that's a cross-section prediction. And in the time series, as I said, if we could find a proxy which would move the big F, we know big F is part of both Z and X, then both Z position and X position would increase, and we would, in a reduced form regression, you would see the UIP increasing and CIP being flat, so it should not show a slope with respect to F, right? And furthermore, because of this interaction, if you remember, between mu and the Z position, any increase in the marginal cost of balance sheet expansion should increase the UIP proportional to the currency gap, and also the CIP should do that. Okay. I will, okay, rush now. So the definition of the way we measure CIP UIP is standard. Just wanted to say that we use both expected UIP deviation using consensus forecast, as well as exposed UIP deviation using actual exchange rates. And that here's the data, the dealer bank's net futures position. We have it from the CFTC at the weekly frequencies for these currencies, the G7 and 4 EM currencies. And it's split in a position of dealer, asset manager, leverage fund, and others. And we basically take the net position divided by the total open interest, which we take a moving average of. And just the standard deviation here just says that the dealer's footprint is very large, about 20% of the market. This is important. Let me just quickly say, the dealer receives the demand for currency risk. But of course, as a dealer, it doesn't keep it on its balance sheet. We all know dealers, they are just in the business of intermediating. They don't take risks themselves. So what we imagine here is that it receives the demand for forwards and futures F. It hedges it, so it has to have the exact same exposure on the liability side, on the other side, but then it has to pass that on to some intermediary. And we think of here being the non-dealer investment bank, for example, but can also be a non-bank. Whoever is in the business of currency risk will need to absorb that shock to currency risk demand and will charge the fee. Here's the result for the cross-section. Remember, we said that the more negative the dollar funding gap, the more negative would be the UIP, and the lower will be the interest rate. That's exactly what we find using both the expected UIP and the exposed UIP, and similar with the CIP. You may think these are very few plots. I just want to show you here. If you do it for other currencies, you get the same. And somebody before also mentioned, so I have a paper with Pierre-Olivier where we, because of the problem of market segmentation that Lorena mentioned, it's very important to, if you want to recover this cross-sectional relationship, to purify of market segmentation and of credit risk. And that's what we do with supranational bonds. And when you do that, they align up on the same line. So it's a general relationship that holds depending on these imbalances of needs for funding and investment currencies. I'll have to rush. So that's the empirical specification for the time series. And as I said, so our proxy is this F. And this F will basically, if you regress on F and you get a positive function, it means that there are a group of intermediaries that absorb this risk along their UIP slope, right? And that's exactly what we find for the dealers, who then pass it on. And that's the coefficient of UIP, both using the expected and the exposed. And as the model predicted, for the CIP, it's flat. There's no slope in F, right? When we unpack the panel, we see exactly what we expected, right? The impact of F on each currency is roughly the same. So, the stability of the slope of the intermediary is kind of given here. But the impact of something like the VIX or, the intermediary wealth and other measures of mu should be proportional to A, to the what we call local currency funding gap. And that's exactly what we see. Here, I order the currencies according to their A. So here are the kind of the funding currencies, their investment currency. And you see how it goes from, the coefficient goes from negative to positive. There's a gradient as predicted by the model. And it will hold with other measures as well of mu. Instead, the CIP, there's no slope with respect to F, but yes, of course, It varies with measures like VIX as well, and it varies in the way also predicted that, for countries with negative X, these are the funding currencies, shock to VIX or shock to mu will decrease the CIP, and then it will increase, but very small for investment currencies. And you can even see it in the raw data. When we bin the funding currencies and the investment currencies, you see how over time they really diverge, right? The funding currency and the investment currency are like an accordion that move in opposite direction, and the balance currencies are in the middle. So that's exactly what the model implied. And what moved the CIP is the exchange rate, the contemporaneous spot exchange rate, right? When the market wants the dealer to absorb the currency risk, the spot exchange rate depreciates, right? Whereas the future exchange rate depreciates by much less, so that creates the extra return the intermediary earns for the position. So when you unpack, you see the same pattern across currencies. Here is just the chart to show you when you decompose the R square, the high R square that we found. By the way, the R square here, in this literature, the R square is basically, a really important statistics for whether we were successful or not. Remember I said if the R square is high, we have identified the agents that absorb currency risk. So the R square here are very high compared to other measures in the literature. And most of that R square is really explained by the net futures position of intermediaries, the red bars. Whereas the slope coefficients are more important for investment currencies because they are more exposed to kind of capital in and outflows of global investors, but still the futures position is super important. So this is a chart that you may find uncannily familiar. Daniel showed it the other day using their very granular and extensive data from the Bank of England. And I think even the correlation is very similar. So all I want to say is that we established this correlation with very simple data publicly available. We don't need 16 million contracts a day. We have one. We have one observation per week. And we get a correlation based on the position of one agent. So that kind of says that this futures position has a very strong signal reflecting currency risk demand. And we can talk about it later. I'm out of time. I just wanted to say that the futures position is also, shocks to it are very persistent, and its persistence is reflected in the response of the spot exchange rate in a way that is exactly consistent with the expected return that the intermediary needs to make. And it basically gives the volatility of the exchange rate and the half-life of exchange rate that matches the data. Okay. Maybe a few seconds. This F, in the end, you may ask, what does it really measure, right? It's just a futures position. And but if it is a true measure of currency demand, it should correlate with pressures on capital flow as well, sometimes. So what is it? It's a demand for currency risk. It could be the demand for dollar investors to hold foreign currency risk, or it could be the demand of foreign investors to hold dollar risk, both negative and positive, shedding or increasing the risk. So we think that if you have a measure for the investment currencies, this change in F should correlate with foreign holding of local currency bonds. That's the channel that Haunan and Lorena were showing. And we find that indeed it correlates with the change in this position for the investment currencies, but not for others. Because for others, like the yen, the Swiss franc, dollar investors don't invest there. They borrow in those currencies to invest elsewhere. So the correlation passes exactly this discrimination test. In those currencies, in the funding currencies, it's the investors in those currencies who borrow invest in dollar, and they want to hedge that dollar risk. So that's exactly the correlation that you would expect. Finally, last word, because of the capital flow, the exchange rate correlates in very weakly, whereas with the F, it correlates with exchange rate for all currencies, and the correlation is very strong. I will not summarize. I will just say that for all policy, this offers a way to target the CIP and UIP depending on which shocks you want to lean against. Thank you.
Thank you very much. Okay, so every time a PhD student asks me what should I work on, I tell them international. And why is that? Because people are so exceptionally nice and international. And so I want to give a round of applause to all the organizers for bringing the profession together and having 2 days. So Christian, Lucio, and Josef, thank you very much. Okay, so excellent paper. I don't want to spend too much time summarizing the paper, but what is the paper about? And what's the contribution? So one of the big contributions, I think, is that they jointly explain CIP deviations and UIP deviations at the same time. And I will show you on the next slide why this is a very hard problem, both in the cross-section and in the time series. So what they do is that they have a partial equilibrium model where intermediaries face some frictions, and these frictions are going to cause these CIP and UIP deviations to vary over time and in the cross-section. So let me show you why this is a hard problem. Okay, so Philip in his discussion said, why don't you do emerging currencies and advanced currencies at the same time? But it is already a very hard problem to do both UIP and CIP at the same time. And I think Lorena's paper, and there are like 3 papers that actually managed to do that. So first of all, the nature of the two wedges is very different. CIP is truly not about currency risk because it's hedged, whereas UIP is fundamentally about currency risk. On the other hand, also the drivers that people have suggested in the literature are fundamentally different. If you look at CIP deviations, they're very slow moving, they're global, whereas if you look at UIP deviations and the literature on carry returns, it's really about the cross-section and the idiosyncratic risk or the exposure to some global risk factor. So I took the same data that they're using in the paper. If you just look at the correlations, so on the left-hand side we have CIP, on the right-hand side we have UIP. What you see here is that the average correlation across the CIP is significantly higher than across the UIP. If you extract the factor from the cross-section, so this is just the first principal component on the CIP, which is the blue line, and the orange line is for the UIP, you see that the time series dynamics are completely different. So if you had told me, go write down a model which explains the time series variation of these two things, I would have said, this is really hard. And it is hard. So just like to give credit to the authors on this is like very hard problem. Okay, so I have 3 comments. The first one is, like, what's the balance sheet of these banks? Who are these dealers? And then I have a comment on the empirics about the time series regressions because they report extremely high R-squared. So let me remind you of the balance sheet that these intermediaries have. So on the left-hand side, you have assets, you have liabilities. Assets are just dollar reserves. There are 2 risky assets. There are risky dollar investments and local currency investments, which are going to introduce currency risk into the balance sheet. And on the right-hand side, you have liabilities, so they need dollar funding in order to offset these things on the asset side. And they have off-balance sheet assets, so these are forwards and swaps. This bank faces a constraint, so they have to fund themselves. So B is just the reserves that they have. There are 2 risky assets, so there's the dollar risky assets, which are H, and then the Z are the local currency assets, which introduce currency risk. They're going to be convex, okay? So if you look at the loadings, A and B, they're going to introduce convex risk into this thing. And then the last term is just what they call default risk. So that's going to be linear. Now, if you solve that whole thing, so the main equation is going to be how do we determine UIP and CIP? They're just going to be determined by the budget constraint and the shadow cost. Okay, so the shadow cost is going to be the difference between the funding that you have and the interest rate and the difference between the two. So this is the plot that Mai showed. The only reason I'm showing it again is what I want you to remember is that the slope for the UIP depends on the shadow cost mu, which is the balance sheet cost, and the size of the step function of the CIP also depends on the size of the shadow cost. So my first comment is related to Angelo's presentation this morning. So what they do in the paper is that they assume that you can get dollar funding via the swap market. But what Angelo was showing us this morning is that there are not just swaps, you can also do wholesale repo borrowing, and there are different balance sheet costs associated to the two. I mean, you can correct me if it's wrong, if I understand this correctly, the type of dollar funding that you get really determines on how the variation looks for these CIP deviations, okay? So it's precisely the difference on whether you substitute repo or swap funding that determines the size of these cross-currency bases. What they also argue in the paper, which is not the case here, because here the bank can be on either side of the trade. What they argue in their paper is that much of this demand that these banks have is structural. And why is that? If you take a European bank based in the European Union, they have a structural demand for US dollar funding. Why? Because they have customers who want dollars and they have to provide these dollars. So they're only on one side of the trade. Okay. So now, does it matter for their paper? I would say in their paper, it doesn't really matter. What you can do is that you can just add a second shadow cost in addition to this value at risk constraint that they already have. So how would you do that? So you can just add a leverage constraint that looks as follows. So now it's just going to be determined not just by the size of the risky positions that you have, but you could also add, for example, some repo borrowing. You could add some collateral cost because you have to post US treasuries as a collateral, and you have still this swap cost, psi, which is going to be very small because it's just 1% usually of notional. So what does that mean? It just means that the shadow price of dealers now is going to be a function of two shadow costs. The first one, which is the one that Mai has in her paper, plus some additional shadow costs. So the lambda t is just going to be the shadow cost for this leverage constraint. And now the effective shadow cost that's going to affect the size of the UIP and the CIP is just going to be driven by this increase in cost. Okay, so now the step function is just going to be bigger and the slope is going to be steeper. Okay, so my next question is, who are these dealers? Okay, so if we go back to the balance sheet, is this really the balance sheet that we have in mind when we look at these dealers in this market? So Mai didn't explain this in her presentation, I think, but what they do is that they take futures data from the CME, and you can go on the webpage of the CME and you can click who are actually these dealers. So here's just the list of dealers. There's the country, and I also added whether these are GSIPs. And sorry, that should be the name. Okay, so if I look at this list, I'm an ignorant person, but most of these companies I have never heard of. Okay, and what you also see is that most of these companies are not traditional banks and GSIPs that you have in mind. So my question to the authors is, do they really, do these companies that are mentioned here in blue, do they really have a balance sheet that looks like the balance sheet that Mai was presenting before? And why do we care about that? Well, most of these companies, if you look them up, these are just high frequency or algo traders. And what's specific to them is that they do not have a regulatory constraint. Okay, so the way that they fund themselves is that they use their own funding. That's why they're called proprietary traders. Now, you could tell me, well, maybe this is just specific to the futures market, but it's not. If you go on the Euro Money survey and you look at the overall trading, what you see here is that you have exactly these people who were in the panel yesterday. So XTX market is, for example, a very big player in this market. And what I also learned yesterday is that it really depends. So these market makers may not participate in all these markets. So spot market is different from forward market, is different from futures market. So my questions to the authors is, when you talk about dealers, who do you have in mind as the dealers? And is the balance sheet that we look at and this regulatory cost, can this really be just the only reason why we have these variations in funding costs? Because to me, at least, it seems that the marginal investor is just going to be a mix of these many different players that we see here. Another thing is forwards versus futures. Okay, so when they construct the CIP deviations, they use forwards, but when they look at the net positions to measure the main variable, they use futures. Okay, so it doesn't matter. Of course, we teach our undergrad students that there's a difference between the two. But the question is, does it matter in terms of the model that they have in mind? Well, I think it does matter in the sense that the leverage, obviously, that you have when you have futures versus forwards is going to be different. Why? Because if you have futures, you mark to market on a day-to-day basis, so the risk that you have on your book is going to be significantly different. So how does it affect their model? Well, if you look at the last term that affects the balance sheet is going to be the way they interpret this is that they interpret this as counterparty risk. Now, of course, if you trade futures, there is no counterparty risk because there's central clearing, okay? So in that case, obviously, I'm going to assume that this delta times xt that they have is just going to be much smaller or play a much smaller role in explaining these variations. So my last comment in the last minute is about the time series regressions that they run. So the regression that they run is that they have the changes in the exchange rate on the left-hand side, and on the right-hand side, they have the change in the net demand for these futures, and the plot shows you the R squared. Now, these are huge R squared, okay? So when I compare, and this is at the monthly frequency. So Lucha has papers and others have papers where they look at flows and regress changes in exchange rates on flows, but at much higher frequency, and they usually get R squares of like 50% and so on. So my question to the authors is, could there be an endogeneity problem that causes just these R squares to be inflated? After all, these futures positions are a function of the price itself. Now, they're very careful in the paper not to claim that there's any causal relationship between the two, but I just suggest that there could be some robustness checks, such as lead lag and so on, okay? So thank you so much for everything. Great paper, and it was a pleasure reading it.
Thank you so much, Andrea, because not only for your comments, which are super useful, but also the way you summarized some of the results and went into some of the things that I didn't have time for. So I will respond selectively maybe to two comments. The first one regarding dealers, I thought the panel discussion yesterday and also our conversation later on were really very illuminating, and that's why I showed the balance sheet connection, the pass-through. We don't claim that it's the dealers who have this balance sheet of the intermediary. The dealers is the front end that receives the demand for currency risk. And if they are hedged, which they are, of course, and they may not have any, it may be all proprietary trading, that risk has to migrate in the system to somebody who eventually absorbs it. In our mind, that somebody is an investment bank, a global bank that does intermediation, or could be a non-bank. And they will still have value at risk, maybe in a different way. I mean, our constraint and our setup is a stylized way to introduce some compensation for risk. It can be in a different form, leverage ratio, as you mentioned, but different form. As long as somebody will absorb that risk and require compensation, the model results will go in the same direction. On futures and forwards position, we probably have to be more careful in defining the counterparty risk to it. At any case, it will imply that delta is very small, and I think that corresponds to that is consistent with our results, where you don't see the CIP moving at all. All of the action in the CIP is due to the global shocks, mu. They just reflect very different types of shocks. Finally, on the R square, that was also actually the motivation for us to put these things together. We were also very surprised. I mean, to the best of our knowledge, there's not one variable out there, single variable, that would have such a high correlation with exchange rate. And people have tried over many, many years. And based on the conversation yesterday and also our thinking, the thinking is the following. Futures market seems to be more and more where price discovery happens for exchange rates. And dealers are an important agent in that market, so they bid with others, and that exchange rate that they bid, they know when they absorb that risk, they will have to pass it on to somebody. And they know about these other agents on the demand side, and so the exchange rate in equilibrium has to be consistent with the UIP of the people who in the end will absorb the risk. So as you said, we don't claim any causality. F could move up and down due to a host of reasons, but it's an equilibrium relationship that has to hold if the intermediary who absorbs this risk requires a premium. So that's what we say. Of course, you had suggestion on how to find IVs, and better identify the source for something like F, and I think there are papers out there that do that, they would be much cleaner identification, the R square will be much smaller. So the goal of our paper is really to characterize the joint statistical properties and the proxies that can have a high explanatory power within a framework that is, that gives you this prediction without really identifying the source of these demand shifts. But with that, I also would like to thank again to all the organizers, and I don't know if there are questions.
So we have time for quick questions and responses. Yes, so excellent paper and also amazing discussion, Andrea, thank you. Related to the point about the R squares, I think working with OTC data for the CLS market, and I think that's what Andrea was alluding to, the R squares, they are substantially smaller. And part of the reason is that if you look at the limit order book regressions and Evans and Lyons have been running, part of the effect is also simply coming by virtue of the fact that it's a limit order book. So when the prices move, the quantities also have to move. So there is almost a hardwired relationship between order flows and price movements in there. So I guess the futures market is very similar to that in that you have an order book there. So I'm a little bit less surprised about the fact that the R squares are so high, because it's very much in line with the limit order book literature there.
Thank you. A great paper. I have a very quick question. So this is an intermediary-centric model. I'm totally with you. But then in this model, how should we think about like the macro risk and its linkage to the macroeconomy? So I know you don't model it, but I'd like to know your thoughts about how to utilize this framework to link it to the macro issues.
Okay, there's one more question. Do you take it?
So it's going to be a very, very short suggestion. In that regression, you had the level on the lag level on the right-hand side of the exchange rate, I think. So that could artificially boost your R square. So maybe you want to throw that out and see how that changes. I find the explanation of price discovery at the weekly sampling frequency not very credible. I'm not sure you can pick that up at that level. But we can just discuss later. I think we're out of time, I've heard.
Okay, so maybe I'll go backward because that's what I remember. Remember the bar chart? So the red bar, that is without anything. That's just like a raw correlation between F and exchange rate. That was almost all of the R square. So it's not because of the lag level. I mean, I don't know why you say you don't believe in price. Maybe we can talk more about it. On your question on macro shocks, so we imagine macro shocks feeding through into this balance sheet of the bank, for example, through the mu, which is the shadow cost of borrowing. And in the appendix, we have tables where we proxy it with different spreads in the financial market, VIX, treasury basis, and so on. And also this F, they have a very strong common component as well. So if you think there can be shocks for dollar assets that are global, that will be reflected in the common component of F as well. And thanks, Fabricius, for your comment on the limit order book.